Hey everyone, and welcome back to the Deep Dive. Today we are diving deep into One Up on Wall Street by Peter Lynch. This one's a classic, and we are going to help you get the most out of it.
Absolutely. There's so much valuable advice packed in here. And it can feel a little overwhelming, right? Like, where do you even start?
Exactly. That's our mission for this deep dive. We're going to pull out the key insights, those golden nuggets, and help you apply them to your own investing journey. And let me tell you, Peter Lynch doesn't hold back. He actually says, the stock market doesn't
All
exist.
right. Talk about a bold statement.
Yeah.
And he's not saying that the market literally doesn't exist. What he's really getting at is that trying to time the market or predict its every move is a fool's errand.
Okay, so don't stress about those daily ups and downs. But then what are we supposed to focus on if not the market as a whole?
Instead of trying to ride the waves of the market,
hmm
you got to focus on those strong swimmers, those individual companies that are going to outperform regardless of what the market does.
I like that. So it's less about market timing and more about becoming a detective, uncovering those hidden gems.
Exactly. It's about becoming a savvy business analyst.
Yeah.
Because at the end of the day, you're investing in businesses, not just ticker symbols.
Right. Businesses we can understand. So he's really shifting our mindset, right? Away from those abstract market forces and towards something more tangible.
Absolutely. And he's also debunking a lot of common investing myths along the way. For example, how many times have you heard, buy a house before you invest in stocks?
Oh, yeah. That's classic advice, right?
Right. But Lynch challenges that. He says, houses are great, but they're not liquid. You can't just sell off a bedroom if you need cash quickly.
Makes sense. Plus, with a house, you're putting all your eggs in one basket, and that can be risky.
Exactly. Investing in stocks, on the other hand, gives you that power of diversification.
Right.
You can spread your risk across multiple companies, multiple industries.
Diversification. Got it. But then Lynch throws this curveball. He compares investing in stocks to playing a 70-card stud poker game. Um, I'll admit, poker's not my forte.
Haha, no worries. It's not about becoming a card shark.
Yeah.
What Lynch is really getting at with this poker analogy is that you got to know the rules of the game.
Right. The fundamentals of investing.
Exactly. And you got to have good cards, meaning you got to be investing in companies with strong businesses and solid
But
fundamentals.
even if you're a good poker player, you can still lose sometimes, right? There's always that element of luck.
Absolutely. And that's true with investing too. There's always going to be an element of chance. But just like in poker, by honing your skills, being patient, and picking those good companies, you can really tilt the odds in your favor over time.
Gotcha. So it's a long game. It's about understanding the companies we're betting on. It's not about those short-term wins or losses. Okay, so let's say we're ready to pick some cards. Where do we even begin finding those strong companies?
That's where it gets really exciting, especially for someone like you who's always eager to learn new things. Lynch is a huge believer in the power of personal knowledge. He famously discovered La Quinta Motor Inns not by poring over financial statements, but while attending a hotel conference.
Wait, seriously?
Yeah. He noticed that La Quinta was absolutely crushing it in the Texas market. They were everywhere.
So are you saying that just paying attention to our everyday lives can give us an investing edge?
Absolutely. Think about it. What products and services are you using that you really love? What trends are you noticing out there? If you see a company doing something really well, that's a signal worth investigating.
Wow. I never thought about it that way. It's like we all have this potential insider information just based on our own experiences.
Right, it's all around us. And Lynch gives us this really useful framework for understanding different types of companies. He breaks them down into 6 categories.
Six categories.
Yeah, slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays.
Okay, that's a lot to digest. Let's
Yeah.
break those down a little bit so we can get a handle on this framework.
Absolutely. Think of slow growers as the tortoises of the investing world. They're steady, reliable companies, like utilities. They might offer some decent dividends, but don't expect explosive growth there.
Right, steady and slow. Okay, what about the next category?
So stalwarts are like the larger, well-established companies. They've got more potential for growth than slow growers, but they're not going to be doubling in size every year.
Gotcha. So like a blue chip kind of company.
Yeah. Think Procter& Gamble, a household name, diverse portfolio, pretty stable. Then you've got the fast growers. Those are the gazelles, the companies that are really disrupting industries and growing rapidly.
Okay, so if we're looking for those big wins, the fast growers are the ones to watch. Although I'm guessing that with higher potential reward, there's also higher risk.
Exactly, it's a trade-off.
Okay.
Then there are cyclicals, which are companies whose performance is really tied to economic cycles.
Oh, I see. So they're kind of like riding the waves of the economy.
Exactly. Think of car manufacturers. When the economy is booming, they do well. When things slow down, they struggle.
Makes sense. What about turnarounds?
Turnarounds are companies that, they've been facing some challenges, but they're working to turn things around.
Oh, the comeback stories.
Exactly. Think Chrysler back in the 80s.
Yeah.
And then finally, you've got the asset plays.
Okay, asset plays. What are those all about?
Those are companies that are sitting on some valuable assets. It could be real estate, patents, even just a pile of cash that the market hasn't fully recognized.
So it's kind of like finding those hidden treasures on a company's balance sheet.
Exactly. Sometimes those assets are hidden in plain sight.
Okay, I'm starting to get a clearer picture of how to categorize these companies. But then Lynch also talks about this concept of the perfect company, which sounds almost too good to be true. What does he really mean by that?
Well, he's being a bit humorous there, but he's really highlighting some characteristics that can often signal a good investment opportunity. The perfect company might have a really dull name, a boring product, be a spin-off, operate in a niche industry.
Wait, why would those things be considered perfect? It sounds counterintuitive.
Right. That's exactly the point. Those types of companies are often overlooked by Wall Street. And that creates an opportunity for us, the individual investors, to find value that others are missing.
Oh, I see. It's like looking beyond the hype and finding those hidden gems.
Exactly. He gives some specific examples of these perfect companies. One is Crown, Cork, and Seal. Makes cans and bottle caps.
Not exactly glamorous.
No, not at all. But incredibly profitable. Another example is Agency Rent-A-Car.
The ones that give you a loaner car when yours is in the shop.
Yep. Not flashy, but a solid business with a clear need.
Okay, so the key takeaway here is don't be swayed by hype or fancy names. It's about digging deeper and really understanding the underlying business.
Absolutely. Now, on the flip side, we got to watch out for those companies that are all hype and no substance. Lynch calls those whisper stocks.
Whisper stocks.
Yeah. Think high-tech companies with these fantastic stories. But when you look closely, the fundamentals might be a little shaky. All sizzle, no steak.
Oh, I see. So they're kind of like those long shots, right? High risk, high reward, but also high chance of striking out.
Exactly. And he compares them to things like jungle remedies and miracle cures. He even admits that he personally lost money on every single whisper stock he ever bought.
Ouch. It's definitely a lesson I'd rather learn from his mistakes than my own, especially in today's world of social media and all the hype that comes with it.
Absolutely.
Yeah.
It's easy to get caught up in the frenzy.
So how do we avoid those traps? What are some financial metrics we should be watching to make sure we're making smart decisions?
Lynch really emphasizes focusing on earnings growth, not just industry expansion.
Earnings growth. Okay.
Yeah. He used the example of Philip Morris. They were in a declining industry, tobacco, but they consistently grew earnings.
How?
By controlling costs and raising prices.
That's an interesting example. So it's not enough to just be in a growing industry. The company itself has to be effectively managing its business and actually growing its earnings, right?
Exactly. Earnings are key.
Yeah.
But looking at earnings alone doesn't give us the whole picture, right?
Right. How do we put those earnings into context? What should we be comparing them to?
That's where the PE ratio comes in.
The PE ratio.
Yeah, the price to earnings ratio. It helps us determine if a company's stock price is fairly valued, relative to its earnings.
Okay, so a high PE ratio means the stock might be overvalued?
Could be.
Yeah.
Even if the company's doing well, a really high PE ratio could be a warning sign. But it's not always a bad thing.
Oh, I see. So context is important. Like a fast-growing company might have a higher PE ratio just because investors are excited about its future.
Exactly. You got to look at the bigger picture. Lynch uses this great example with McDonald's back in the 70s.
McDonald's?
Yeah. It was an amazing business, but the PE ratio got up to like 50.
Wow, 50.
Yeah. And eventually the stock price crashed, even though McDonald's was still a great company.
Interesting. So it's about finding that sweet spot, a company with strong earnings and a PE ratio that makes sense, right?
Exactly. You don't want to overpay for growth. What other financial clues should we be looking for?
Well, I remember Lynch talking about cash position and book value.
Right. Cash is king, as they say. A strong cash position gives a company flexibility.
Like a financial cushion.
Exactly.
Yeah.
And then book value can sometimes reveal undervalued assets.
Hidden assets like we were talking about before.
Yeah, sometimes. But book value isn't always the most reliable indicator. Remember, we're like detectives here. We're piecing together clues.
So any examples where those clues led to a good investment?
Lynch talks about Ford in the 80s. The company had this huge pile of cash. Yeah. And that gave him the confidence to hold the stock, even when people thought it was overvalued. Boeing's another example. The stock price was so low at one point that you were basically getting the core business for almost nothing because of all the cash they had.
Wow. It's amazing what you can find if you dig deep enough. Okay, so we've learned how to categorize companies. We've got some key metrics to watch. What happens when we found some promising companies? What's the next step?
Well, that brings us to selling.
Selling.
Yeah, knowing when to sell is just as important as knowing when to buy.
That's a good point. It's easy to get caught up in the excitement of buying, but selling can be tough.
Totally. Lynch is all about the long game, you know? He's not into that short-term trading
Let's
mentality.
buy and hold. Let those winners run.
Exactly. Minimizes costs, maximizes gains. It's all about finding those great companies and sticking with them.
That sounds very much in line with his ignore the market philosophy. But does that mean we hold on to every stock forever? When do we know it's time to let go?
It's not about holding blindly. Lynch himself sold Apple in the early 80s,
Mm-hmm.
thought it had peaked.
Oh, really? Apple?
Yep. But then he talked to his kids, and it changed his mind.
Wait, his kids?
Yeah. His teenagers were obsessed with Apple computers, and so were all their friends.
Huh. That's a great story.
Right. It made Lynch realize he'd underestimated the company's potential. He bought back in and rode that stock to even greater heights.
Wow. So it's important to stay informed, be flexible, and not be afraid to, revisit our assumptions. But what about those times when a stock is tanking and we're filled with doubt?
Hmm.
How do we know if it's just a temporary dip or a sign that something fundamental has changed with the company?
Yeah, that's tough. Lynch warns us about those psychological traps, like thinking
Right,
it can't go any lower.
right. So we hold on, hoping for a rebound.
Exactly. Or the opposite, thinking they always come back, so we buy more of a fallen stock.
Yeah, I can see how those thought patterns can lead to bad decisions. It's all about fear and greed, right?
Pretty much. The key is to take a step back and reassess the fundamentals. Has the company's story changed? Are earnings still growing?
If not, maybe it's time to cut our losses.
Could be. But if the fundamentals are still strong, a price drop might be a buying opportunity.
Right. Okay, that's a really important distinction. So we've covered a lot here. Debunking myths, finding winning companies, understanding key metrics, knowing when to sell. But Lynch wrote this book back in the 80s. How relevant is his approach in today's market? I mean, things have changed so much.
That's a good question. And it's true, the investing landscape has evolved. But a lot of Lynch's core principles are timeless, you know.
Like what?
Like his emphasis on personal knowledge, his distrust of hype, his focus on earnings and fundamentals, those are as relevant today as they ever were.
It's reassuring to know that those fundamental principles can still guide us. So it's not about trying to predict the future, it's about understanding the present and making informed decisions. Right?
Exactly. And, even Lynch, a legendary investor, missed out on some big winners. He wasn't perfect.
Right.
Oh, yeah. But he had a process, he did his research, and he stayed disciplined. That's what made him so successful.
So as we wrap up our deep dive into One Up on Wall Street, what are the key takeaways you want our listeners to walk away with?
I think the biggest takeaway is that you, the individual investor, have more power than you think. Don't be intimidated by Wall Street or all that jargon.
Right, right.
Focus on what you can control. Finding great companies with solid fundamentals.
It's about taking ownership, not just blindly following the crowd.
Exactly. And don't underestimate the power of your own knowledge and observations. Like Lynch with La Quinta, right?
Yeah.
Those everyday insights can lead to some really great investments.
Yeah, it's like he's giving us permission to trust our gut, Be curious, do our own research.
Exactly. And remember, investing is not about getting rich quick. It's about building wealth steadily over time. Patience and discipline. Don't fall into those emotional traps.
The marathon, not the sprint. This has been so insightful. I feel like I have a whole new perspective on investing. I'm excited to put all this into practice.
That's great to hear. Knowledge is power, especially when it comes to investing. And speaking of knowledge, here's a thought-provoking question to leave you with. Lynch was a master at finding those next stop-and-shop companies, right?
Right.
Those seemingly mundane businesses that turned out to be huge winners. What seemingly ordinary companies today might be tomorrow's big winners. What's flying under the radar that maybe we're taking for granted?
Wow, that's a great question. It really gets you thinking.
Exactly. The best opportunities are often hidden in plain sight. It's about connecting the dots, seeing the potential that others might miss.
I'm already starting to brainstorm. This has been such a great deep dive. Thanks so much for walking me through all of Lynch's wisdom.
It's been my pleasure. Remember, you have everything you need to be a successful investor. Now go out there and discover those hidden gems.
I'm on it. Happy investing, everyone. We'll see you next time on The Deep Dive.